All right, let's jump right into it. Welcome to this explainer, where we're going to definitively break down the two main paths to making money in the stock market. You know, we hear the words trading and investing tossed around all the time, often used interchangeably, but as we're about to see, they are completely different beasts. By the end of this explainer, you're going to have a crystal clear understanding of which of these paths actually fits your lifestyle, your risk appetite, and your financial goals. So let me ask you something, and hey, be totally honest with yourself here. Do you want to make money fast in the stock market? I mean, it's a really tempting idea, right? The thought of a quick profit, seeing your money grow in a matter of days or even just minutes. But this desire actually sets up the ultimate central conflict of the stock market, the battle between the immediate gratification of quick returns and the long-term patience required for massive compounding wealth. To kick things off, let's dive into Section 1, the mobile shop analogy. Before we get bogged down in all the confusing financial jargon, let's just ground this in a totally relatable, real-world example. Imagine a guy named Baba Rao. Baba Rao runs a great mobile shop. He buys phones for cheap, sells them at a profit, everything's going great. But suddenly, a rival named Totla Seth opens up right across the street, selling the exact same phones for 1,000 rupees less. Instantly, Baba Rao's customers just vanish. But wait, Baba Rao sees the news. A massive global chip shortage means these specific phones are going to stop being manufactured. Demand is absolutely going to skyrocket because the supply is dying out. So, Baba Rao now has two options. Option 1. He can wake up every single morning, buy all the cheap phones from his rival Totla Seth for 9,000 rupees, and immediately flip them in his own shop for 10,000 rupees, pocketing a quick 1,000 rupee daily profit. This quick turnaround, this daily flipping to combat his rival, that perfectly represents trading. Now, option 2. Baba Rao can buy those exact same cheap phones from Totla Seth, but instead of selling them today, he stores them in a warehouse. He waits for months, he's patient. When the chip shortage fully hits the market and these phones are practically impossible to find anywhere, he brings them out and sells them for 12,000 rupees, making a massive profit. Hoarding them for a future demand spike? That right there perfectly illustrates the patience of investing. All right, moving right along to Section 2, the core differences. Now let's transition from Baba Rao's mobile shop directly into the actual mechanics of the stock market to see how these two distinct strategies function when you're dealing with shares instead of smartphones. This brings us to the investor's primary toolkit, which is called fundamental analysis. When you choose the investing path, you aren't just looking at random numbers on a screen. You're looking for fundamentally strong companies that are going to generate solid profits in the future. You're basically asking, hey, is this company actually worth my hard-earned money? Will it grow? If the answer is yes, you put your money in, the company then takes your invested capital, launches new products, expands their business, and hires more employees to increase production. As an investor, you're literally buying into the actual business model of the company for the long haul. Now contrast that with the trader's toolkit, technical analysis. A trader operates completely differently. To be totally blunt here, a trader does not care what the company actually does. They don't care about the management team, they don't care about the shiny new products, they don't care about fundamental analysis at all. A trader wakes up, opens the market, and stares at chart patterns. They track the daily price movements, the tiny ups and downs, looking for immediate, short-term opportunities to buy low and sell high. They are analyzing the market's behavior, not the company's business. So, what is the crucial point here? It's time. Time is absolutely the biggest differentiator between the two paths. Trading is an incredibly fast-paced environment. We're talking about time horizons of minutes, days, or maybe a few weeks. It is all about getting in and getting out. Investing, on the other hand, is a decade-spanning scope. We are talking about holding for 5, 10, 20, or even more years. It's literally the difference between sprinting a 100-meter dash and running a lifelong marathon. But you might be wondering, if an investor is just sitting there waiting 10 or 20 years, what happens in the meantime? Well, dividends happen. While long-term investors are patiently waiting years for the overall stock price to rise, good companies know exactly how to keep them happy in the present. When these fundamental companies make those big profits we talked about, they take a small, regular chunk of that profit and pay it directly to their investors as a bonus reward. This is called a dividend. And get this, there are investors out there who make massive, consistent incomes purely off these dividend payouts, just for holding on to the stock. No trading required. Which brings us to Section 3, the risk and stress factor.
The stark contrast in these two lifestyles is absolutely fascinating. The daily life of a trader is a high-stress daily grind. Their heart rate is basically tied to the chart, panicking when it drops, elated when it rises, and it's a zero-sum game. The source material beautifully compares trading to a massive game of a coin toss. People are betting on whether the price goes up or down. For a trader to win and make money, someone else on the exact opposite side of that trade has to lose their money. Conversely, the investor enjoys real peace of mind. It's an invest and forget mentality. You put your money into a great company, you close the app, and you just go live your life. You aren't stressing over daily dips because you know that in a few years the price will likely bounce back and climb higher, allowing you to enjoy the massive benefits of compound interest without all that daily anxiety.
All right, let's get into the nitty-gritty in Section 4, hidden costs and taxes.
Okay, let's talk about something nobody really likes to discuss, but it's absolutely vital. We need to prepare you for the brutal financial realities that eat into your profits because making money in the market, it definitely isn't free. 90%. This is a shocking, sobering statistic drawn directly from our source material regarding trading. 90% of beginner traders lose 90% of their capital within their very first 90 days. I mean, read that again. It is incredibly risky. Because trading is highly complex, the seasoned professionals usually win, and the eager beginners who think they can just jump in and make a quick buck end up losing almost everything almost immediately.
And part of why it's so hard to keep your trading profits is because the government and the brokers always win. When you trade and you actually manage to make a profit, the government takes a massive bite, roughly 28% in taxes. On top of that, because traders make so many transactions every single day, they rack up incredibly high brokerage fees. Plus, if you want to trade in futures and options, you have to provide complex documentation like full income statements. Compare that to investing. The long-term capital gains tax is much friendlier, sitting at 20%. And because you're just buying delivery shares and holding them, your brokerage fees are incredibly low, sometimes even zero depending on the platform you use. Plus, all you need is a basic demat account to get started. Investing is fundamentally way cheaper to execute.
Let's wrap this all up with Section 5. Where should you start?
So, bringing all these concepts together, where does this leave you? If you are just starting out, here are your absolute golden rules. First, know that the barrier to entry is super low. You can start both trading or investing with a minimum of just 100 rupees. Second, and this is absolutely critical, avoid the trap of thinking you can turn 1,000 rupees into 1 crore overnight through trading. That is a total fantasy, and it's just going to leave you demotivated and broke. Now, if you're a salaried worker, someone who has a full-time 9-to-5 job, and your main goal is just to grow your savings for the future, you should honestly just stick to mutual funds and investing. You do not need the stress of trading in your life. And finally, when you do start, make sure you choose reliable brokers with easy user interfaces so your app doesn't just crash right when you're trying to make a move. So if you want the absolute ideal path, step by step, here it is. Step 1, do not start with trading. Start by buying delivery shares. That is basic long-term investing. This is how you actually learn the basics of how the market moves. Step 2, patiently gain experience. Watch your investments over time, really understand the rhythms of the market. And only then, at Step 3, once you have solid experience and you are earning your own money, should you try trading. And even then, only attempt it with very small amounts of disposable income that you can truly afford to lose. Trading is an advanced skill. You absolutely must master investing first. And that brings us to the end of our explainer. I want to leave you with this one final thought. Are you looking for the quick, high-stress thrill of a daily trade, knowing full well the massive risks involved? Or are you seeking the lasting peace and the incredible compound growth of long-term wealth through investing? Look, there is no inherently wrong answer, but you absolutely must know which game you're playing before you put your money on the table. Choose your path wisely.